In this video, I'm going to break down private placement life insurance. We're going to talk about the math behind the product. That is exactly what it is. It is a product that is being sold by the wealth planning industry. It seems sophisticated on the surface, it's a complicated product, but the reason people want it is because you don't pay capital gains tax. So before you get too excited, let's go into the math behind the product. What it feels like is a ready-made buy, borrow, die product, but you're going to pay for the fact that it's a ready-built Happy Meal version of buy, borrow, die. Let's get started. How long does it take to set this up? Maybe 6 months to 9 months. You're going to need to go through rigorous medical, legal work. Just to get the product open, it might cost you between $50,000 to $200,000. So massive upfront cost. The client does not pay a monthly life premium. And this is exactly why it is so dangerous. Remember, the wealth is extracted through the fees and through your actual liquid net worth. This is how they get the clients in. And this is exactly why it's so dangerous. So the bank or the wealth planner is going to siphon your net worth slowly over time. Let's get into the tax side of it. The state premium tax in New York and California, up to 3.5%. Federal deferred acquisition cost, 1.5%. So the insurance doesn't pay it, it's passed on to you. So straight away, if you're investing, say, $10 million, it is now 9.3 million before you've even started, just through fees, setup, and time. Not to mention the IRS are cracking down on this product, on this structure. So even having the product, you are putting a target on your back from the IRS. That's something that people need to be aware of. Now, before we even get into the product being open, we now have the financial parasites, which I like to call. The admin and the management, just for actually having the product, 0.5% estimated for the administration. That's of the net worth. Then you have the actual cost of the insurance. This product needs to convince the IRS that it's a life insurance policy. That's the whole point. To make it look like life insurance, when really it's a tax wrapper. The IRS already know exactly what it is and what's been done. And just to make you aware, the IRS already know of every single tax wrapper, structure, trust, offshore trust, everything. You're not outsmarting the IRS. People think they are, but they're not. You're not outmaneuvering them. They already know every trick in the book. The key is to be transparent and to do things the right way. And I'm going to talk about that. So you have the cost of the insurance. This goes up as you age, so it compounds as you age. Again, taking more of your net worth. The asset under management fee. What have I talked about in my videos? If you're ever met with an asset under management fee, you should respond with outright refusal. 1% sounds like nothing, but it's 30% of your potential future net worth. It's taken before that wealth is even come into existence, because it's taxed whether the market's up or whether the market's down. It is a wealth extraction from your net worth. This is one of the biggest wealth extractions in the full industry. Now, the IRS have got rules on this product. You legally cannot choose investments. It is entirely up to the fund manager to make every single decision. If there's even an email from you to the fund manager, I'm thinking maybe it's a good idea to sell Nvidia, to buy Nvidia, the IRS will pierce the product, pierce the tax wrapper, and tax you aggressively. So you have absolutely no autonomy in the investment choices. So it's a financial straitjacket. You're also trapped in the ecosystem of the bank or the wealth planner or the financial planner or whoever's selling this product. So you're trapped forever with no control over your net worth. And you need to ask yourself, mathematically, does it even make sense to pay all these fees? Would you maybe have even just been better off paying capital gains tax? Because that's the way it looks after you account for all these fees. So we're forced to diversify under IRS Rule 817H. So if we're forced to diversify, outperforming the market is now 10 times more challenging. This is what I talk about on the channel. The biggest mistake people make with buy, borrow, die is borrowing against assets that are not outperforming monetary inflation. Monetary inflation runs about 7%. If the portfolio is only doing 10%, after all these fees, and you're taking a loan, and who's providing the loan? The fund manager, the bank, whoever gave this product. They're going to probably likely provide you the line of credit, charge you an interest fee for the loan. So you're stuck, you're trapped in this system. But it feels sophisticated. So we're diversifying the portfolio, you have no control over the investments, and you're borrowing against it. This is all leading to slow liquidation of wealth. We're supposed to be trying to build generational wealth, but instead we are slowly liquidating it for the next generation. The wealth industry is the sales industry. The broker, the wealth planner is getting a 6-figure commission for this product. See, this is what I'm trying to explain with the banking industry. It is a sales industry. Take it from someone who first job was in the bank. I was in the bank for over a decade. If it wasn't for regulations, the sales would be so much more aggressive, you would think it was like a used car sales industry. I promise you that. Take that from someone who worked for one of the largest banks in the world. I'll tell you what the PPLI is for. If you're too lazy to set up a trust. I'm going to make it so simple what true asset protection involves. True asset protection involves 3 things. A good lawyer who understands what we're trying to achieve. A custodian, like an institutional broker, a brokerage account. And a trustee, a professional trustee. 3 things, and that is asset protection. Out of those 3, I didn't even mention a bank once. See, what part of it was a bank for asset protection? A bank, the true elite operators, use a bank like financial transit, financial plumbing, just somewhere to take the money out, to spend the money. It is not asset protection, because on this channel, we talk about how a bank really works, how its balance sheet really operates in comparison to a brokerage. Brokerage, your assets are all segregated security. Cash in the bank is not protected. You probably already know that. But private placement life insurance, avoid, unless you want to be in a financial prison. This is the video every wealth planner, private bank and banking industry pray you never watch. But this is the truth. So the IRS know every single trick. The IRS are aware of it. They're aware of everything. We want the IRS on our side. Because if you do everything correctly, transparently and legitimately, you have the strongest financial entity on earth on your side. This is important, the most important factor when it comes to asset protection. Play by the rules. It doesn't matter what you're trying to do. If you think you're getting an offshore trust or whatever it may be, everything should be declared to the IRS. Everything should be done compliant and proper. And then you actually get the benefits of asset protection. But trying to trick the system, trying to think you're outsmarting the system, you're going to end up losing. So in the description, there should be a box or a link for you to submit your email. If you submit your email to me, I will tell you what custodian I personally use, what institutional broker I like to use. The only reason I can't say it on YouTube is it's against the rules. cannot promote financial products, financial platforms, unless you're paid by such platform. So if you drop me your email, I'd be very grateful, and I hope this information is useful to you. The content on this channel could save you millions over your lifetime. This information will save you generational wealth in the form of fees you didn't pay. So I hope you like the video. If you do, please leave a comment. I'd love to get your feedback, and I'll be making more.